Yeah, we're privileged to have clients all across the US, a wide reach, as you say. The good news is that clients are so far sticking to the plan. There's no panic. And that's our advice, to lean into that volatility in a disciplined and diversified way. We still operate in an uncertain environment, no doubt. But at the same time, history can be a friend in the sense that we know that historically, the last 15 years, these have been short-term impacts to the markets. They have not left a lasting mark.
Edward Jones' clients had Big Mag 7 gains. Maybe they've pulled back a little bit. Maybe somebody's even at a loss. Is it a tech opportunity right now?
I think we have seen over the last 12 months some re-rating happen, no doubt. Software stocks and positioning has really turned a corner, and now we have seen a little more strength. I think the earnings story remains intact, but I believe we are transitioning from the first phase of AI, where it's all about the development, those people, those companies that facilitate the build-out, towards the dissemination and adoption. So I think that broadens the opportunity set.
Damien, I've just got to continue with the headlines to the Middle East. I'm sorry to interrupt. Qatar says threat level high, asks people to stay home. This is Doha, and of course there's 6-7 hours ahead of us right now. Call it early afternoon. Damien Sessauer.
Angela, we had Lisa Shalit of Morgan Stanley on earlier, and she talked about how war-induced oil shocks have never been kind to equities over the last 80 years. Almost every episode's resulted in an economic recession here in the U.S. And yet, I'm hearing that from you that this might just be short-lived. And, I'm just curious to hear your thoughts. I mean, what makes you believe that this time is different?
Well, if we look at the last 15 years, how markets tend to perform is oil prices rally into these events and peak shortly thereafter. When we look at the Iran-Israel conflict last summer, 10 days after, that was when crude peaked. Looking at the Russia-Ukraine invasion back in 2022, that was 3 months that oil prices peaked. And 12 months in all of these cases, the last 15 years, oil prices were lower. So no doubt there is going to be a short-term impact. But at the same time, the US economy is less energy intensive than it used to be. And also, we know that it is all about the flow. There is ample reserves in oil once the situation normalizes. Nobody knows the timing and the duration, but at the same time, it's always have been a wrong move to make reactionary decisions based on these headlines.
Yeah, no, I don't disagree with that. But I mean, my goodness, you are seeing Germany and Japan, hitting their strategic reserves. And, things seem to be getting a little bit lost in the mix here. And so, I'm just, in terms of investor positioning, what are you advising? Are you advising to take advantage of the current conditions to maybe lean in and maybe, buy some of these beaten down equities and maybe large cap tech or whatever? Or are you suggesting that people kind of hide out, go defensive, maybe look at safe havens? I mean, what are you telling clients?
I think a broad mix of investments can help prepare for different scenarios. We've run a study for those investors that wanted to move to the sidelines every time these big events happened for 3 months. That would have been the wrong move. The way to lock in some either losses or really miss out on some of these long-term returns. Thinking about the first month and a half of the year, we saw that through broadening mid-caps, small-caps, international, these are the investments have got pulled back the most since this conflict started. So if this proves a bit ephemeral, that's probably where the opportunity lies.
Is cash an asset class?
Yes, it is. But at the same time, when we look at investment-grade bonds, high-quality bonds that offer an extra yield that you can lock in for longer, probably that's the way we would, advise to move some of that excess cash if it is too much for some clients.
I'm sorry to throw you a curveball here, but we've been seeing all these headlines about JP Morgan, about Apollo. Now they're going to value their private credit funds on a daily basis and things like that. I mean, what are your thoughts on private credit? Do you see that as a risk to U.S. financial stability?
Potentially a risk, but not a systemic risk. At some point, we're going to have a credit cycle, but I don't think that point is now. The Fed still has a bias to cut interest rates. The U.S. economy is chugging along. Some of the fears around software might be overblown, but no doubt it is an area that we are monitoring closely.
I look at one final question. We've got to run here to all the news flow that we've got this morning is, well, what are you going to write about this weekend? If we get to the weekend, I got a CPI report in 20 minutes. Do you have like a script, or are you just day to day as you go as a strategist?
I think in this market, we got to be flexible. We know that headlines can change in an instant. But I think if we take a step back, really, it is still all about AI. That investment boom continues. Oracle was a good indication that demand remains high. And then, of course, the geopolitical developments. It's hard to avoid that. We don't want to dismiss any near-term risks, no doubt.